Hey guys, welcome to the channel and welcome back to another video. On today's video, we want to have a conversation today about the Fed funds rate. And what did the Fed do today? Because the Fed had their announcement today. The Fed came out after their two-day meeting between the FOMC, Federal Open Market Committee. It's the committee in the Fed who actually makes a decision of whether or not they should raise rates or whether or not they should leave rates alone in terms of the Fed funds rate or if they should increase rates. So there was a meeting today, and there was a conference, a media conference where the Fed chair Jerome Powell gets up and has a conversation about what decision the FOMC made, and the decision today was that they were going to not increase rates. The Fed decided to leave rates where they are, which they've left them where they are for like about a year straight with no change. And so here's the deal. As an investor, how does that affect you? Right? So urgent, urgent, urgent. The Fed interest rate decision was today. Stop spending, stop what you're doing, and do this now. This is a conversation to have for people who invest, for people who are consumers, right? Let's talk about three things I want to cover in this quick video, guys. The first thing is, what was the Fed's decision? What was said today at the press conference that Jerome Powell did? Second thing I want to talk about is how rate cuts affect the stock market. And then thirdly, I'm going to talk about, as an investor, what you should be doing right now before rate cuts do happen. There was no rate cut today. The Fed said we're leaving them alone, but there was great indication there will be a Fed funds rate cut in September. It's coming, right? I don't want to leave this live broadcast today without giving you things to do as an investor in the stock market. Very important you guys know that. As you come in, guys, let me know what city, state, county, country you're stepping in from, what continent you're on, and we can get this ball rolling fairly quickly. Eddie in the house from Seattle, good to have you. Mrs. Moore, appreciate you being here. Thank you so much. Let's see. Hey, the Willie Wilo is here. I appreciate you. Thank you so much for being here. Listen, I want you to stop spending and start investing. Why do I want you to start investing? Because I want you to be ready for what's going to take place when these rate cuts do happen, right? I want you to at least be getting your money ready if you're not already dollar cost averaging in. And let me know if you can hear me. Give me a thumbs up if you guys can hear me okay. John Joe in the house, good to have you. I appreciate your support. Regina is here from Buffalo, New York, right? Upstate New York. Maple Shade, New Jersey's in the house. Harrisburg, Pennsylvania is here. Queens, New York, and Puerto Rico is here. Good to have you. Let's see here. So, what was the Fed's decision today? Let's just jump right into it, guys, and give me a thumbs up if you want. If you're watching on Facebook, glad to have you. If you're watching on Instagram, appreciate you being here. If you're watching on LinkedIn, shout out to you on LinkedIn, right? Appreciate you. Ohio's in the house, Dallas, Texas in the house. Jackie, let's see here. Blue Butterfly, thank you for the thumbs up. If I have any problems with this audio, guys, let me know right away. I'll try to keep up with the chat and we can ditch this microphone because I've had some static on this mic recently. Lebanon, Pennsylvania's in the house. David's from Illinois. Good to have you here. Hey, PL's here. Valencia's here from Michigan. Good to have you, Valencia. What city are you in, Valencia? So we got Durham, North Carolina here as well. So guys, don't forget to hit the thumbs up button. We're going to go through this information and kind of, have a little back and forth. I'll be checking the chat here and there, guys. So the dual mandate, this is what the Fed decided today. They talked about, and I'll take these off. The Fed talked about the dual mandate, and they always go over this dual mandate all the time, every single meeting they have. By the way, I want you to notice something about the Fed. The Fed is very, very, very measured in what they say because they know that what they say is can sway markets, right? It's going to sway investor sentiment one way or the other. So the Fed is almost a PR firm. It's almost a communications firm, just as much as it is as a monetary body, right? But they have a dual mandate. The dual mandate is what? Maximum employment and stable prices. That's the two things that they always talk about every time they get together and have their press conference, right? Today, the Fed chair said the labor market is coming into balance. Here, I took a few notes. Let me actually pull them up real quick. I took a few notes on what he said. I just want to give you a brief because, listen, I know a lot of you didn't sit through that 45-minute press conference and that he had a 5 or 10-minute talk and then he answered questions. I know you didn't do that, so I summed it up for you. Let me pull out my notes for you. unemployment is low. He said that inflation eased from 7%, which we know it was 7%, middle of 2022, down to about 2.5%. And he still said he harped on the fact that we want our inflation to get down to 2%. He said basically the FOMC is leaving the Fed funds rate right where it is. Fed funds rate being the rate that banks charge one another for overnight lending. When that rate goes up, for those little short-term 1 week loans that they give to each other, when that rate goes up, your rate goes up for when you go get that car at the bank, or for when you go get that short-term loan somehow, getting something, your credit cards, right? Rates go up there when rates go up, when the Fed fund rates goes up, right? He also said, hey, we're also going to let bonds roll off our balance sheet, right? Now, the Fed controls inflation in two ways, guys. It cuts and raises interest rates, and it has a balance sheet. Now, I'm not going to talk about the balance sheet. I don't want to go down that route. That's a little more in depth than I want to go. But just to say, he said today that we're letting bonds, basically, he said we're letting bonds roll off the balance sheet, which means basically we're reducing the supply of money in the market, right? Less liquid. We're pulling money from the market. Remember, pandemic, we flood the market with money. They flooded the market with money, bought bonds from banks and so forth. Now banks had money to loan. Now you were out buying, getting loans because the interest rate went down, etc. Right? Whole big economic thing. He said the GDP first half of the year is only 2.1%, down from 3% last year. He said consumer spending slowed but remains solid. He also said improving supply conditions are happening right now. He said the unemployment rate remains low, which we know the last report was 4.1%. He said more and more workers aged 25 to 54 and more immigration. He actually said that. That's not a talking point. It's not a political thing. He said there's more and more workers in the workforce between ages 25 and 54. And he said we have more immigration. He said the labor market has returned to where it was basically on the eve of the pandemic, where the supply and demand of labor is coming more into balance, basically. He also said that I'm just giving you a rundown of what was said today, and then I want to get into how it affects us as investors, right? He also said the core PCE is at 2.6%. The core PCE, so you know, that's not the headline inflation. The core PCE is another inflation reading. The headline inflation is the CPI, right? The core PCE inflation is different. It excludes food and energy. Why do they exclude food and energy? Because the Fed says food and energy is very, very volatile. So if we want a better, more accurate reading, we get rid of food and energy. And we really focus more on the PCE inflation, core PCE. So we said it's down to 2%, but we want 2.6, but it's not but we want that at 2%. We don't want it at 2.6. We want it at 2%. And we're going to keep on doing what we got to do until we get it closer to that. So, and as you know, inflation erodes our purchasing power and so forth, right? But he said right now we're going to hold this Fed funds rate steady at between 5.25% and 5.5%. By the way, back in the pandemic days, 3 years ago, that Fed funds rate was near 0%. And they hiked it up and hiked it up and hiked it up and hiked it up because they wanted you to stop spending, stop spending, stop spending. It's more expensive to borrow money, more expensive to borrow money, stop spending, so that they can hold down inflation. Because inflation goes up when demand goes up. And when there's so much money in the market, and everybody's getting their stimulus checks, we can all spend money. We can all buy. When you buy and everybody's buying, demand goes higher and prices go higher. So the Fed said, let's stop all that. So we're going to raise the rate. And now it costs you more to get a loan, and you're going to be less incentivized to go get that loan. Right. He also mentioned that there's greater confidence. There's greater confidence. We're going to get back down to 2%. He was very, very careful, very, very measured, how he always is, because they know they say the wrong thing, problems. Right. Now, the stock market is pricing in a rate cut. Remember, we always talk about on here, the stock market is forward looking. It's looking at what's going to happen down the road. So when you see the stock right now, the stock market is pricing in about one, I think, yeah, the stock market is pricing in one rate cut coming in September. It's already priced into what you see happening with the stock market, right? So if inflation remains on the current trend, he said it may be appropriate to cut rates, right? So that kind of said, oh man, all the investors in the stock market, right, said, oh yes. And so the stock market kind of rejoiced at the idea that he sort of hinted to rate cuts coming in September. But he said, as long as unemployment remains low, growth in the economy remains fairly strong, and inflation data continues to press down, we could possibly have a rate cut coming in September. But he was very careful to measure it with those words. As usual, he just didn't say a whole heck of a lot, right? He said a few things, but he didn't say a whole lot, right? But the deal is this, and let me see what we got in the chat, guys. Make sure we get okay. We're good in the chat. All right, just want to make sure that we didn't lose our speakers. Hey, salute back to you. Jay Samuels is in the house. Good to have you here. Let's see. Pistol Pete said the Fed speak stuff is translating one language to another. Yeah. All right. Yeah. So here's the deal, Valencia. When the Fed rate, when inflation goes down, it doesn't necessarily always mean that it doesn't mean that prices are going down. It just means prices are increasing at a slower rate, right? So we got to get that in our head as a consumer. We're thinking, oh, I don't see inflation going down. Prices are still really high. Well, prices are always going to be high. They're just going to get higher at a slower rate. So instead of getting higher at the rate of 9% year over year, they're going to get higher at a rate of 2% year over year. So they're still going to be high. They're just getting higher slower, if that makes any sense. So sometimes we got to kind of fix that in our mind sometime. I get caught up in that as well. Birmingham, Alabama in the house. Good to have you. Appreciate you being here. Hey, Validate is here as well. Good to have you as well. So basically, he said a rate cut in September is on the table. I think he used those terms, on the table, right? And he said that, it may be time to dial back restrictions. And that is translated into rate cuts. Remember, guys, rate cuts are inflationary. When the rates get cut, that incentivizes people to go out and do what? Spend more money, because now money is cheaper to borrow. And that's for us as consumers, and it's for businesses too, right? So, he was also asked, I thought was interesting, he was also asked by a reporter about could the rate cut in September or something, some type of activity by the Federal Reserve in September, the next meeting, could that be construed as maybe a political thing as we get closer and closer to elections, right? And of course, in typical Fed fashion, he said, we'll never try to make a policy decision based on a potential presidential outcome or things like that. So he kind of actually he was a little more, I would say, firm on that point than he normally is. So here's my take: we will see a 25 basis point cut in September. That's my opinion. That's really what the market is saying as well. We will see a quarter. 25 basis points is a quarter of 1%. That's 0.25 percentages, right? 100 basis point is 1%. I think we're going to see a 25 basis point or a 0.25% cut in the rates with the September meeting of the Federal Reserve. Okay. But he also went on to say that the economy looks a lot different right now, right? Things are different than they were a year ago, et cetera, when they first started leaving the rates where they were. So investors sort of cheered this thing on, and it sent stocks a little higher today, right? The S&P and so forth. So 3 takeaways real quick from the meeting today with the Fed and what the Fed say, the warning that the Fed said that interest rate decision is going to stay where it's at. The big takeaways, guys, really is not just the fact that, one, they're keeping the rates where they are. Keep in mind, this is not mortgage rates. Right? Fed funds rate is not mortgage rates. Mortgage rates are typically determined more so by the 10-year Treasury, not necessarily the Fed funds rate. There's an indirect effect, right? It's not a direct effect. effect. So when the Fed funds rate goes down to 1 and 2% again, then we'll see our mortgage rates ultimately follow that same pattern and get back down to 3 and 4%. Because as you notice, the Fed has raised the Fed funds rate over the last few years, and so mortgage rates have sort of followed, right? So it's not a direct correlation, but an indirect correlation between mortgage rates and the Fed funds rate. The other takeaway was that the economy is still expanding at a solid pace based on GDP, low unemployment still, and based on what we see in terms of inflation coming down a little bit, right? And also that further progress has been made, right? That's kind of what he kind of zeroed in on quite a bit in today's meeting. Let me go to the chat real quick before I go to the next segment, guys, which I want to talk about as an investor. How does the Fed funds decision affect the markets, the stock market? So let's talk about that. Mikey is in KC mode. Good to have you here. Let's see here. You take on the Fed is much. Your take on the Fed is much appreciated. Thank you, John. Just hey, I know people ain't sitting around watching the chairman Jerome Powell have that conversation today. And since hey, let me sum it up for you, right? Let me sum it up for you. So I appreciate that. Let's see here. Prices slow down, but rate cuts have a lag effect. Yeah, rate cuts, just like rate hikes, they have a lag effect. And what that means is just simply it takes a while before their policy decision to raise or lower rates actually trickles down to what we see in our everyday economy. That's just what a lag, L-A-G, just how it sounds, right? So when they go to cut the rates in September, there's going to be a lag effect there as well, where it'll take a while before we start feeling it a little bit different. Right, Renita, good to have you here. Renita's in Austin, Texas. What are your thoughts on leveraged mutual funds? I know about the fees and management fees on mutual funds. Yeah, mutual funds are cool, but again, fees. I'm much bigger on index funds, which index funds are a type of mutual fund. Much bigger on index funds and ETFs. Let's see here. Utah's in the house. Good to have you here, guys. Do me a favor, if you watch us, hit the thumbs up button for me. Just tap it. Take out 2 seconds and tap that thing for me. Let's see here. John Joe said, "Yep, rate cut unless something crazy happens in the Mideast." That's something to think about. All right, there's some geopolitical things happening right now in the Middle East, right? With what happened with these leaders. One leader was killed, 12 people were killed, and one leader was killed, kind of going back and forth. That's going to be a hot button topic right there. And it may have an effect on certain stocks or some sentiment around stocks as well. So thanks for bringing that up. Appreciate that. Let's see here, 0.25% on the 18th, perhaps. So let's talk about, yeah, hit that thumbs up, guys. Very important. Appreciate it, Walla. So let's talk about as an investor, how does this Fed decision to leave rates where they are affect us? It doesn't always affect the market, right? We got to remember that. The Fed funds rate, the change one way or the other, doesn't always affect the stock market, right? It doesn't. It absolutely doesn't. Now it could, and here's some of the ways it can affect us, businesses, and the market. Because there's three places, right? It's going to be us as consumers, us as investors, and the stock market itself. So in terms of borrowing, right? The higher the Fed funds rate, right? The more the Fed raises that rate, like they had been doing, of course, as we know, borrowing costs for us goes up. But here's something that a lot of consumers don't think about. The borrowing cost for consumers goes up as well. I said consumers. For companies goes up as well. So businesses, they have to, a lot of businesses strive on debt, the leverage of debt. And if you're a business, like I'm making these caps right here, if I'm a business making caps, now I got to go borrow. I got a $50,000 piece of equipment that I have to borrow money on. Well, now that's going to cut down on my bottom line called profits because I have to borrow money at a higher rate. So these higher interest rates don't just affect us as consumers with, the money we're trying to borrow or on our credit card. It affects companies as well, right? And it can lead really to companies having to spend more, which means on borrowing costs, which means slower growth, right? And that could potentially have a negative impact on the stock prices. Now, when the Fed decides to lower these rates, that's a nice sign. for, say, a company like this company that wants to go out and borrow money to get the equipment, piece of equipment that's $50,000. Now I can borrow it at 4% as opposed to borrowing at 9%. Can make my bottom line look better. So lower rates is good for me as a business, right? And of course, we know it affects consumer spending, obviously. Right? When your mortgage loan goes up, your car loan goes up, your credit card interest rate goes up, everything that's a problem as interest rates go up. And as interest rates go down, again, it's an incentive. It's a it incentivizes us as regular retail consumers to go out and and spend more. Now, here's what I'm telling you on this video. When the Fed makes a decision to lower their Fed funds rate in a couple of months, you don't have to go with the flow that says, let me go spend. I want you to be prepping and preparing because you're not only dollar cost averaging into the stock market as a regular investor, but I want you to be thinking about the lean times that may be coming. Now, everybody's talking about we might have a stock market crash. Look, stock market crashes are always coming. We know they're coming. It could be in October, or it probably won't be in October, right? We have a federal election coming up, right? It probably won't be a presidential election. Probably won't be in October, but it could be January, right? Could be February of next year. Who knows when it's coming? We know that a crash is coming. So you have to, as an investor, sort of juxtapose that with the fact that as the Fed lowers the rates, you might see some more positive activity in the stock market. So as an investor, be ready, right? I don't just want you dollar cost averaging, but I want you also to consider taking advantage with the dips, right? I call it dollar cost average plus, where you're steady putting money in, but you also have some reserve for when you see the stock market go way down or you see a sector go way down, like we saw with tech in the last couple of weeks, right? So corporate profits, companies' profits can be affected by what happens to the interest rates because the interest rates can make a difference in where the stock market itself goes. The other thing to think about, the other effect is us as regular everyday investors, right? Listen, when the Fed funds rate is higher, it can make, you name it, bonds and other fixed incomes look more attractive to larger institutional investors. Now, me and you, we're just retail investors. But Sally Mae and Geico and all these insurance companies, these are though they have millions and tens and hundreds of millions of dollars to invest. Those are your institutional investors, right? But it could make higher rates could make, usually makes it institutional investors more attracted to other investments besides stocks. However, when the Fed lowers rates, it can make bonds typically less attractive and everybody can flood back over into the market. So what happens when everybody floods back over into the market once the rate cut happens in September and there's a shift of capital, what they call a rotation or a shift of capital out of the bond market into the stock market, but at the same time, there's a lot going on there. As an investor, you have to know about all these different pieces, right? As an investor, my thing is this. You got to always be viewing all of these events from a business standpoint because business runs America. Business runs America, whether it's political, geopolitical, wars, elections, doesn't matter. Move, whatever the Fed decides to do, businesses sort of run America. And so you need to be looking at your investments from a business standpoint. It's not only going to help you make better investment decisions, but it's going to help you make overall better decisions with your overall investment portfolio, right? DCA plus. Yeah, let's see here. Oil is seasonal. Look at various timelines. Absolutely. The Nvidia sale was yesterday. And Nvidia got way down to $103 overnight. I think end of closing day was a $103 or $104, right? $103.11 maybe. Hey, I don't know what did Nvidia close it today. Since I just got that question, let me look at it. I didn't even look at it. Closed at 117. Good night. Right? It dipped down to buck oh 02 at one point, 1 p.m. yesterday, closed at 117 today, 117.02. So if you're invested in Nvidia, you see what happened in terms of volatility. Tech stocks are cyclical stocks, by the way. They can go up and down. But what happens to the stock market when the Fed cuts rates? Right? Increased borrowing and spending is going to happen. When the Fed cuts rate, lower interest rates makes people go out and borrow money cheaper for individuals and for businesses, right? Consumers and businesses. Oh my goodness. Now I've been wanting to get that. I can go get that car and I can get it at 3% interest instead of 7% interest. Let me go now borrow that money and get that car, right? This is what I'm telling you. I'm warning you as an investor. Don't do that. You don't have to go and do, you don't have to all listen. The Fed is sort of the puppet master. Let me just be flat out with you, right? Because I don't want to play any games with you. The Fed is the puppet master, and the consumers is on a string. What I'm telling you when I tell you stop spending money and do this, is I'm telling you you don't have you need to cut the string. Right? There's a string attached to your back and attached to what the Fed has going on. And I'm telling you that you need to cut that string. Just because the Fed says money is cheap to borrow, it doesn't mean as an investor, as a consumer, you have to run out and start borrowing money. Right? You don't have to act like the puppet on the end of the string just because they cut the string. They're going to reduce rates in September. Doesn't mean that you have to go out and start borrowing money. It means that you need to pay attention to what's going on with the stock market when that happens, because it may offer either some opportunities to purchase before that. So you need to be looking. We're going to be having these conversations right before the next Fed meeting coming up in a couple of months, because I want to be letting you guys know where to have your head at is in terms of as an investor, right? But lower interest is designed to get you to get out there and spend money, right? It's designed to get you to go out and start making the machine work. You are the little bitty worker. All of us together are the little bitty workers that are making the machine work, right? Now, also when they cut their interest rates, it could lead to maybe some higher valuations, right? So lower rates reduce what they call the discount rate. Um, and that leads to higher, what they call present values for future earnings and higher cash flows. And this typically can result in what we see as higher stock prices, right? And then you'll see that as we get closer and closer to the next meeting, where they're anticipated to actually um, decrease rates, right? Future cash. So stock valuations typically depend on what they call future cash flows, right? That are discounted back, right? Discounted back. Future cash flows that are discounted back to what the current value is. And I don't want to go too deep into that, but you get what I'm saying. I hope we get what I'm saying. So lower interest rates basically are, they also, here's the other thing that I didn't mention. Lower interest rates, when they lower interest rates, what is that going to have on investor sentiment, right? Because a rate cut usually indicates that the Fed is doing something to support the economy. And what do people think about when they say, "Oh, the Fed is doing something to support"? We start looking at the Fed as like, "Oh man, the Fed is doing something really good for us." This is what we start thinking, right? And this plays in our mind. Oh man, that Fed, they lowered the interest rates. Man, they're working on the economy. That's what we automatically think when we see interest rates go down, right? Sometimes we forget that they're working on interest rates when they're raising rates, when they're leaving it the same, and when they're lowering it. But sometimes our sentiment, the Fed gets a pass when they start lowering rates and making money cheaper to borrow, right? Because think about it. Back in 2000, 2001, when the Fed funds rate was 0 or 0.5%, nobody was complaining about the Fed. Nobody was upset about the Fed. Nobody had something negative to say about the Fed because all was good, right? when they start lowering rates, it changes the way we think about the Fed. And when that changes, we all of a sudden have a more favorable outlook and we feel better. And now what happens when people feel better, right? Just like puppets on a string, when we start buying more, right? It's like we got to pull ourselves sort of out of that rat race, right? Rat race, yeah, the machine, right? So listen, some folks, as interest rate falls, right? There, as I said earlier, maybe a shift from bonds to stocks, right? And then you got to think about certain sectors. Somebody brought it up earlier in the chat. Certain sectors benefit from rate cuts, right? There's certain sectors of the market, sectors of industry that are more sensitive to these rates than others, right? You think about, for example, let's think about real estate. When the Fed lowers the Fed funds rate, and all of a sudden the 30-year fixed mortgage goes from 7% down to 4%. That's a sector of the market that relies on these interest rates, right? The borrowing cost, and again, they're not directly tied, but they're indirectly tied, right? So sometimes when you see that happen, you got to be paying attention if you have, REITs, or if you have actual real estate itself, or you want to buy a home, right? So certain sectors are affected differently by rate cuts. And also, I think a lot of people forget that lower interest rates depreciates the dollar. When the Fed lowers the interest rates, it makes the dollar cheaper and therefore worth less, which in turn, watch the ripple now. The in turn is it makes exports, what we send out, cheaper, right? And so it makes the earnings of companies that are buying those exports higher. So and which if you're buying stocks like TSMC, that's kind of a weird example, but it could have an effect on their bottom line as well, right? So there's a lot of ripple effect that happens, guys. A lot of ripple effect. Let me see where we are, guys. Let me know if you guys can still hear me. I think you can. Let me see. We had a question I missed earlier. Somebody put a Q in the chat. Appreciate the Q. I might have passed it up. I'm not very good at the chat, but I try. Let's see here. Somebody said it actually hit 100. Was that Nvidia that hit 100? I didn't think Nvidia hit 100. Let's see here. Oh, by the way, before I go further, don't forget to look in the description box, guys. I got Mint Mobile down there. Check them out. Also, there's some free stuff down there in the box as well, some other videos you can check out. So please take a look at what I got in the description box if you're over here on YouTube. If you're not on YouTube, feel free to join us. Feel free to subscribe to this channel on YouTube if you want to, Smart Money Bro. So NVIDIA went down. I didn't know NVIDIA went down to 100. Tell me when that was, by the way. Let's see. While I'm all heavily into REITs, I'm not heavily into REITs. I do have a REIT ETF. Let's see here. Memphis 10, Shelby County. Eric Moss is in the house. Good to have you here. Appreciate you being here. So, changes in the Fed funds rate, right, can signal a lot of things for us as investors, right? The overall impact on the stock market is not just determined by what happens with the Fed funds rate. There's broader things that's going on, right? Including what I last mentioned, investors and consumers' perceptions of what's going on, right? While we know that rate cuts generally support, like today, you saw that they indicated that we're going to be decreasing rate cuts. Okay, the market responded a little favorably today, right? That's businesses responding favorably to say, hey, I can go borrow some money at a cheaper price and so forth, and I can advance the profits of my business, right? But there's other economic conditions that are important that you got to consider and think about, right? The Fed funds rate can have an effect on the stock market and on borrowing cost and on consumer spending and on corporate profits, domestic and international, and on our behavior as investors, right? So we have to know this. So what I try to do here on this channel, guys, is help you guys be a more informed, wiser investor, and not just somebody who sees a story on CNBC and goes and buys a piece of a company, goes and buys some stock, right? Go and buys some stock. There's more to this investing thing than just doing it like that, right? I want you to have a plan. I want you to have a strategy. I want you to have some core values, core beliefs, and I want you to know what your risk tolerance level is. I want you to know how all these outside factors play on your investment decisions. I want you to make a decision. Do you want to buy single stocks? Do you want to buy ETFs? Or do you want to actually buy real estate, right? What do you want to invest in? Commodities, whatever it may be. But you got to make that decision for yourself, right? Rate cuts absolutely are coming in September. I think it's going to be at 25 basis points. Here, let me get to what you should be doing right now as an investor, because I would never want to do a video, show, video, a live, whatever you want to call it. I never want to do one without giving you some tangibles, right? Not just telling you what's going on and trying to get you to clickbait, but I want you to actually learn something and gather something from this meeting that we have, right? Because otherwise I'm just on here trying to make money off of you. And believe me, I'm not trying to make money off of you giving you some clickbait. I'm trying to give you something that you can infuse into your own investing, your own bank of knowledge, right? Guys, don't forget, hit the thumbs up button. Do me that favor, hit the thumbs up button. And also, if you know somebody that's interested in learning some information, understanding what the Fed is doing right now with interest rates and how their decision impacts investors, consumers, etc., share this link to this video with them, right? Just shoot it out to them. If you got a question, put a Q in the chat and I'll try to get to it before we get out of here. But I want to talk about what you got to be doing right now. Right now. First thing is this, guys. You got to be looking at your allocations. When I say allocations, I mean looking at whatever you have invested. Doesn't matter what you have invested. You need to be looking at your allocations and saying, okay, is the money that I'm invested going to the right places based on my age, based on my goals, based on my risk tolerance level? Is my money going to, listen, I gave this example before a couple weeks ago. I'm gonna give it again. I know people, and you probably know people, and you may be one of these people who have been investing 5 or 10% of their money at their job for years and years and years and haven't even looked at their portfolio, not realizing that the whole 10 and 15 and 20 years that you was investing your money, you had it in, they were putting your 401k money in the safest bond possible that they had available. Instead of you being 35 years old, taking some risk and, yeah, I want to be risky with my money, they were putting your money in the fund that was only getting 1% annual return on investment, was only getting 3% annual return on investment, when all the while you had the choice to actually have your money allocated different, but you just didn't know. You didn't think about it. Because what happens with a lot of people, even today, because right now they automatically enroll a lot of people at jobs into the retirement system or 401k, 403b. So here's the deal. The first thing you got to do is you have to review your allocations. Figure out where your money is going to, whether it's the 401k or it's your own personal brokerage, whatever it could be. Robinhood, whatever, Stash, wherever you keep your money. Review your portfolio allocations. Stocks, bonds, other assets, where's your money at and where's your money going? Now, where you had your money going at age 30 may not be the same place you want your money to go to at age 50. Very, very important. If you don't get anything else out of this entire video talking about warning, Fed interest rate decision, at least get this from it. Know where every dime of your money is going that you are investing. And consider shifting things around if you have to, right? So you can get some exposure into different sectors that you may want to be exposed to now that 10, 15 years later. right? Maybe you want to be in utilities and you want to have some, you want to own some ETFs that are part of energy or consumer staples like food, clothes, whatever, right? That's the first thing. Check your allocations. The other thing, maybe you might want to identify some stocks that are sort of interest sensitive or maybe dividend paying stocks, right? As sometimes these lower interest rates happen, which we will see happen here shortly, they make dividend paying stocks a little more attractive because remember what a dividend is. A dividend is when a company shares some of the profit with you, the shareholder. And when they share profits with you, guess what? When interest rates get lower, a lot of time stock companies make more profit. And so if they make more profit, it means your dividend might go up. That's why you may want to look at some dividend paying stocks, right? Now, some folks would say, hey, you know, check out the fixed income investments. I'm not a big, when I say fixed incomes, we're talking about bonds, typically bonds, right? Typically, bond prices will rise as interest rates go down. Typically, but of course, nothing's really typical, especially nowadays, right? Excuse me. But you might consider some long-term bonds. Excuse me. You might consider some long-term bonds, right? Some folks like them, some folks don't. Listen, somebody on this chat or in this room might be 65 years old. They don't want to fool with the potential of 8 or 9% return on their money, 12% return on money. They might be cool with a 1 to 2% return on their money. You cannot leave people. I'm not going to be the person that never talks about bonds because I don't like bonds. I'm not a big bond person, but I know for a fact that there's people in this room, this chat, watching this video that invest in bonds. I know for a fact, whether it's bond ETFs, individual, whatever it could be, corporate, government, right, treasury, T bills, what have you. So typically, bonds do go up a little bit when we see interest rates get down or go down. Typically, not all the time. The other thing you need to be doing right now is you need to be monitoring the financial information that's coming across the feeds, monitoring the financial information that's coming across with the Fed, like I'm trying to give you on this video. Fed information is important for your stock portfolio. Stay informed with the Federal Reserve communications. Look, Jerome Powell, there's 12 districts to the Federal Reserve. Jerome Powell is not the only one that speaks. He's the one that speaks at the end of the FOMC committee meetings 8 or 9 times a year. But there's 11 other Fed district chairs. And these people, they speak all the time, right? Information comes out all the time, and you can listen to what they say because they're in the room oftentimes when they have these meetings to decide what's happening with the federal funds rate. So the other thing you got to do, you're not just monitoring financial news and all that stuff just to monitor what the Fed says, but also you want to be aware of market, the sentiment, because how people feel is always reflected in how they spend their money. What's happening in the market? Are people not spending as much? Are they spending more? Right? We see this every time, every year. Come November, December, people start spending more money because they get into a mood, and it's the feeling of the Christmas, Thanksgiving season in America, and all that stuff. Right? So the sentiment is important too. Right? Now also there's some people. Watch this now. There's some people who bought a home in the last 2 years and they have a 7% mortgage. Well, what do you think is going to happen when the mortgage rate goes, the average mortgage rate, let's say for a 30-year fix goes down to 4%? The people that bought the homes in the last year or two, when rates was at 7%, 7.5% for a 30-year fixed, they're going to be doing what? Refinancing their mortgages, right? They're going to jump in that market and start refinancing their mortgages. That's okay too. Keep an eye out for that, right? As well. Let me see something, guys. Let me go back for a second. I think I had a cue in the chat. If I didn't have a cue, I might have missed it. Let's see. Boom, boom, boom. Somebody said, I'm 56 years old with a little pension. This was a while back. 56 years old with a little pension. Should I invest in a risky ETF? Listen, the answer to that question, I just highlighted that on the screen, Kelly. Kelly, thank you for the chat there, Kelly. Kelly, if you're 56 with a little pension, depends. How long do you plan to work, Kelly? Do you plan to work till you're 70? Do you plan to work till you're 80? Do you want to retire at 61? Makes a little difference. Should I invest in a risky ETF? What is a risky ETF? The whole purpose of an ETF is to lower your risk because it puts you gives you a basket full of stocks. Now, some more volatile ETFs could be like your tech stocks or your semiconductor ETFs, right? They might be a little more. They might have more fluctuation to them. So should you do that? It depends on a lot of different things. What's your risk tolerance, Kelly? Can you stand some risk? How much extra money do you have besides the little pension you have, right? I would say that as you get older and older, typically people try to reduce their risk and mitigate their risk more as they get older because they're going to be needing the money sooner. If you're 26, you won't need the money for about 35 years. But if you're 56, you need the money in 5 years. And so the stock market in general goes up, down, up, down, up, down, up, down in the short run. This is why people, as they get older, they don't want to deal with individual stocks because there's too much volatility up, down, up, down, up, down, right? So you got to think about maybe some safer investments or some things. There are some ETFs that may not be as risk averse as well, Kelly. So I hope that helps you out a little bit. Let's see. Let's see here, Mike Kelly. I thought I saw a Q in here, guys. I'm in VTI and VOO. Why VTI and VOO, Mikey? You don't have to be in both. You could, solely up to you. But if you track, I want you, Mikey, to go over to ETF.com and I want you to track the difference between VTI and VOO. Their performance is almost identical to the T. So having money in both of those is overlap, too much overlap for me. But I appreciate you bringing that up because that offers a good chance to have that conversation. There's a question. Is it normal for my job to not tell me? Is it normal for my job to not tell me what my 401k is invested in and stop me from seeing? Appreciate it. Eddie, it's not normal. I think if they're putting your is it a pension or a 401k, one way or the other, you ought to have access to where that money is going. That's your money. So it's not normal for them not to tell you. They should tell you where it's at. Let's see here. Willie Wilo, my 401k is an AF target date of 2040. That puts you at about 2040. That puts you at about 40 years old, right? So let's see. But I'm thinking to change it to FXAIX, which is available for me to change to. Good question. I'm not big on target date funds. I'm really not big on target date funds, me personally, because I like the control. I'm a control freak when it comes to the money, right? I want to be able to tell the money. I don't want them automatically figuring out, okay, I'm getting a little older, so I got to go in bonds more. I don't like that. I want to make that decision. So, Willie Wallow, it's up to you. If you don't mind them making the decision for you to be more conservative as you get older, go for it. But if you want to have the decision to do what you want to do with your money and you like the volatility of FXAIX, that's cool. I think FXAIX is it the S&P 500 on Fidelity? But I would say I like the control. You can do what's best for you. There is a little bit more, there may be a little more volatility to being in FXAIX if you can stomach it. All right. That's my thought process on that. Let's see. I complained to HR 2 times and the expense ratio is too high and they lowered it. 0.3%. Okay, cool. Hey, appreciate it, Chase. Thank you so much. McDonald's is slow. I got home at 3% before COVID. I'm happy. Chase, that's fantastic. 3%. You got in right at the right time. Fantastic. Congratulations to you. It's pretty awesome. Okay, get the likes up. Thank you, Mrs. Moore. I got a few more things to share with you guys, so don't go anywhere yet. Kelly said, I want to retire in 7 years. So, Kelly, if you want to retire in 7 years and you only have a small pension, I don't know that you want to go with, volatile ETFs, a volatile ETF. Maybe you want to go with a safer ETF, right? Where you can still enjoy the diversity. At the same time, you can also feel a little safe about it, right? As you get older, since you want to retire fairly shortly. Let's see here. Pistol Pete. I just like that name, right? I'm a basketball guy, right? Let's see here. Although I'm wearing a baseball cap. Any questions? What are your thoughts on investing with my HSA? HSAs are pretty cool, man. HSAs are pretty cool, and I think you get to keep your HSA as well for quite a while. I think it's a good idea. Keep if you're asking, should you have an HSA? Great. Yes, keep it, have it. Nothing wrong with it at all. You could. I know people with a couple of $100,000 in their HSA, right? Let's see. So let's jump back into this, guys. Let me see if I can't. I don't even have my. I'm supposed to have a blue light behind me, guys. Nobody told me. I like the blue light better. The blue light is kind of a little more relaxing, right? Is that better or should we go bright? You guys tell me. Go bright, go blue light. Bright, blue light. Bright, blue light. All right. If you guys like the light, we'll put it back. Let's see here. I'm likely changing over to FXAIX. All right, fantastic. So what else can you do? Right? We said monitor the financial information coming across your feeds, staying aware of what the Federal Reserve is doing, be aware of investor sentiment. We said you can evaluate bonds if you like. Again, I'm not a big bond guy, but some people say that hey, that's not a bad place to go when the interest rate's lower. Research sensitive stocks are stocks that are going to be that are sensitive with interest. When interest rates go down, these stocks go up, right? And also know what your allocation is. I think we said that a while back. Please, 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 investors, stay diversified. Do not get it. Do not bend to the temptation. Don't bend to the temptation that says, you know what, Nvidia is killing the game. Forget about all that other stuff I was doing. I'm going to put all my money in Nvidia. Don't bend to that. Don't do that. And I've heard a lot of people do that recently that have emailed me and said, I'm all in on Nvidia. I got my 401k at my job, and I'm putting all the rest of my money in Nvidia. Please, please, please. Diversification is crucial to managing risk. The one thing that few people spend much time thinking about as investors is risk. But I'm telling you, you always have to consider risk. Always, especially when you're talking about policy or monetary changes, a decrease in the Fed funds rate. You got to be thinking about risk, 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 risk. It ain't, look, I could do a video about risk and nobody will watch it, right? Very few people will watch a video about risk, right? Now I could do a video about, somebody said this about somebody else, and somebody said this, and somebody called this person a name, and I can get a million views, right? But if I do a video about risk, no, crickets, right? But risk is like really, really important, and a lot of people that have these conversations on the internet talking about money and stocks and all, they don't spend enough time on understanding how to evaluate, manage, and mitigate. You cannot get rid of risk. It ain't going nowhere. There's a risk in everything you do, right? There's a risk in having your money at the Navy Federal down the street credit union. That's a risk, right? Because you're getting, less than 1% interest. The fact that you could have it getting 10% interest somewhere, you're risking the money. So there's risk involved in every single thing you do with money. Always understand that, right? Always. But listen, this is my warning to you guys. The Fed interest rate decision was to keep everything exactly where it is. Don't change nothing. But they indicated strong indication in the words that Chairman Jerome Powell said. They indicated that there's a rate cut coming in September. What that means for you as an investor, you as a consumer, right? You as a small business owner, or you as a person who invests in businesses, you got to know that, right? You got to be made aware. And that's one of the things I try to do on this channel is to keep you guys informed when something important happens. And it's pretty important to know, right? Any more questions? Let me see where we are. You got a question, put a Q up there. I'll try to give you my best answer. Kelly, the link to have a one-on-one with me or to jump on my schedule or to join me on Patreon, where we dig deeper into individual stocks, And I take you guys behind the scenes of what I actually invest in. Last time I was over on Patreon less than a week ago, I showed you the backside of exactly what my investing strategy is into individual stocks. How I even showed my portfolio of exactly what's on my watch list for stocks I'm watching and all that good stuff. But that's in the description box on YouTube. You'll see a link to that information where you can jump on my schedule, you can get on the Patreon, you can do a one-on-one with me, what have you. Either way, we can have that conversation. So I hope that helped you, Kelly. Let's see here. Dastardly. We'd love to hear the risk with Nvidia as a company. Yes. You know what? That's a great question or comment. I'm writing that down right now. I think you just gave me an idea what to talk about on Thursday, tomorrow. Because there are risks with Nvidia, right? And if you own Nvidia stock, if you own, even if you own Nvidia in an ETF, it's really applicable to you. You have to know the risk involved with Nvidia, and everybody's giving you all the positive, the wonderful. It's a buy, and all the experts are saying, get out there and get you some Nvidia. Yes, go buy. Here's what's coming up in AI, and I've done that too, right? I've had videos on here where I talked about all the positives. But we need to explore what some of the risks are with NVIDIA so we can just be honest and be real with you guys, because there definitely are some risks with NVIDIA and you got to know it, right? If you don't know the risk involved of something that you put 10,000 and 20,000 and $50,000 in, that's a problem. So maybe we'll have that conversation. I appreciate that, Dastardly, for you giving me that information. Perhaps we'll have that conversation. I like it. I like it. Man, you guys are sharp. I always say we got some sharp folks in this chat. So I don't know what that means. That means maybe you guys, I'm fairly sharp. So you guys come over here and you're sharp. I don't know, but you guys are sharp, man. Sharper than me. I'm just a regular guy trying to give out information. You guys are more on the ball than I am. Somebody says I'm 62 years old with 100% stock in all my brokerage accounts, except for the one I use to trade stock options. Cool. Not mad at you at all, Eric. Sounds like he's on the ball. 62 options trading, right? It means he's making some money on the side, doing well. Thanks, Eric. I appreciate that. I have an opportunity to assume a house for 20,000 with 45,000 of equity. Should I proceed? That's a great question. Let me answer that, guys. So Steve said I have opportunity to assume a house, and I'm assuming, Steve, that's an assumable loan, right? So you guys that may or may not know, then these assumable loans are usually older loans that have been around for 20, 30 years, right? Assumable loans are loans that you can take over from somebody, like a mortgage that you can take over, and they don't have to check your credit or not. You just take over the mortgage, right? I actually did an assumable loan one time years and years ago. But he says it's the house for $20,000 with $45,000 worth of equity. Shall I proceed or pay down high interest loans? Steve, you got to give me more context for that question, right? Give me a little more context for that question. Matter of fact, Steve, formulate that question really well for me. And then once we end this video, I want you to put that question in the comment section of the video on YouTube, and I'm going to answer it there. That way I can give you a nice, well-written answer, but I need a little more context to what's going on with that house, Steve. I really want to attack that for you. Let's see here. I think they will cut. I think gas will go up and force the data to say a little. Hey, election season coming up also. What's going to happen around election time, right? We got to be thinking about that too. So you're basically saying that extreme dip. Listen, there's always going to be a dip coming in the market. Always. Crash is always near and dear. So be looking out for that, guys. Listen, I hope I gave you something at the end of this video, some steps you can take as an investor, what you should be doing right now. As a retail investor, if you follow what I talked about in this video, you can better prepare yourself for the potential, not the guaranteed, but the potential impacts of these interest rate cuts that are coming. Don't wait until September to adjust your portfolio or to be looking at things and learning new things, etc. But be thinking now so you can position yourself to capitalize on these market opportunities, and at the same time be managing these risks that are going to come up as well. But to be a solid individual stock picker, or even to be a solid person with your now ETFs, index funds, you know, you've already mitigated a lot of risk just by virtue of having one and having 100, 200, 500 different companies in the bucket, right? You've already mitigated a good amount of risk already. But if you're an individual stock picker, you need to be paying attention to all these things even more closely. And yes, tomorrow, I think I want to have that conversation about the problems with NVIDIA, the issues with NVIDIA. That way, you can make a more informed decision if you should buy more, if you should buy less, if you should hold your position, if you should keep it in an ETF, if you should leave it alone altogether because you're just not quite sure and you don't want to be involved with it. That's a great one. Who gave me that? Was it validated? No, was it validated? Who gave me that idea? Man, that if you give me who gave me that? Oh, Dastardly gave me that idea. Dastardly. Send me an email. Send me an email. I want to give you something. I want to shoot you out something. We're going to be doing a show coming up soon about some giveaways and so forth. But Dastardly, shoot me an email. I got a gift card coming for you. Nobody else shoot me an email. All right, please don't. But shoot me out something, man. I got something for you for giving me that idea. I appreciate it. One of the hardest things to do when you do these YouTube channels is coming up with ideas and things to actually present and have conversations about. So if you guys think of anything else, drop it in the comment section. Listen, I appreciate you being here more than you know. Chase, thank you for being here. Oh, get those likes up, by the way. Do me a favor, hit the thumbs up button, share the information with somebody that you know. Check out the free information in the description box, right? 24 Laws of Money ebook that's free. You can check out my actual website, smartmoneybro.com. Go join me on Twitter, X. Go join me on Instagram. Go join me on LinkedIn. Go join me wherever you want to join me. Facebook, our Facebook group. Come check me out on all those places. We talk money everywhere we go, right? So, and also, as I always say, before I end any broadcast, I appreciate you, Walla Mala, Chase, right? Drizzle, Team Massive, Eric Moss, Mrs. Moore. Thank you so much, Mrs. Moore, for manning the chat for me. I appreciate you. Gary, Steve, Robert, Pistol Pete, right? Eric again, Eric Moss, Kelly, Six Speed, Case Techoff, Brian Lewis. I appreciate you guys being here. Listen, as I always say, very important, guys. Don't forget to smash the like button. As I always say, the best person who's going to take care of the older you who has to pay rent or mortgage, has to pay for food, has to pay for lights, water, right? The best person that's going to take care of that old you is not the government, is not whoever the next president's going to be. It's not your grandkids. It's not the nursing home or the older facility. It's none of that. The best person to take care of that old you is the young you today, right? That's the absolute best person on the planet who's going to take good care of the old you. Take care of yourself, take care of other people. Until the next video, peace.